is this banking crisis you may have heard of?
What is the Fed poised to do tomorrow? Hike rates again. It is almost unimaginable to me. Yes, we have a problem. All these banks have a lot of underwater assets.
What on earth is going on? This is what we will understand today. Hello and welcome back to the channel. My name is Herve. Some people just call me Vey or V. On this channel is where I bring you predictive analysis, research and tutorials to help guide you as you go through this vast world of coins and tokens. If that is the type of content you find interesting, be sure to like this video and subscribe to the channel with your notifications on so that you do not get to miss the next value-packed video like this one. Also be sure to check out my links in the description, links to the Discord and Telegram channel and to my Instagram, as well as links to the exchanges that I use to buy my coins and tokens. The concept of banking dates back thousands of years, with evidence of banking-like activities found in ancient civilizations like Mesopotamia, Egypt and Greece. However, modern banking as we know it today emerged during the Renaissance period in Europe, particularly in Italy. The first modern bank in the world is generally considered to be the Banco di San Giorgio, which was established in Genoa, Italy. I hope I pronounced that correctly. In the year 1407. The bank served as a public depository for government funds and also provided loans to merchants and governments. Other banks were established in Italy during the 15th and 16th centuries, and the concept of banking eventually spread to other parts of Europe and the world. Today there are many different types of banks, including commercial banks, investment banks, central banks and more, each with its own specific functions and roles in the financial system. When you keep your money in the bank, the idea behind your action is to save your wealth so that you can use it at a later date in the future. This is an idea that we as humans have had for a very long time, to save value. However, there is a lot that happens behind the scenes. You see, the bank is a financial institution whose primary function is to accept deposits, aka your money, and use those deposits to provide loans and other financial services. So simply, your money is not kept in the bank, it is used. Now, you might be like, if the banks use my money to loan out to other people or companies, how come I can still go to the bank and withdraw my money at any time? The answer to this is banks practice fractional reserve banking. As of May of 2021, banks in the United States with more than 122.3 million in deposits are only required to maintain a reserve ratio of 10%, meaning that they must hold 10% of the total deposits as reserves. For banks with less than 122.3 million in deposits, the reserve requirement is 0. It's worth noting that many banks hold reserves well in excess of the required minimum, so more than 10%, in order to ensure that they have sufficient liquidity to meet unexpected demands from their customers or from the broader financial system. So you see that at any given time, the money that you take from the bank is just an accumulated 10% reserves from everyone else using that bank. And if everyone was to come for their money, there will not be enough money for everybody. So banks by definition are insolvent, much like FTX. Now, banks are businesses, and like every other business, they have to make a profit. They do this by investing in safe assets, or may I say supposed to be safe assets, like government bonds. A quick question you might ask: what the hell are government bonds? Government bonds are a type of debt security, or say are a way for the government to borrow money from people like you and me. When you buy a government bond, you are essentially lending money to the government. The government promises to pay you back the money which you lend to them, called the principal, plus a little extra money as interest. The interest rate is like a fee that the government pays you for lending the money. So these are considered to be very safe assets because, after all, it's the government, yes? So banks may buy up these bonds or lend out money to the government, which is money gotten from people like you saving with the bank. They may also loan the money out to regular people, giving mortgages, which are also considered to be safe. Now, all of this is great in a normal economic environment with low inflation. But when inflation starts to kick in, the Federal Reserve may be forced to start raising interest rates. This is bad because interest rates have an inverse correlation with bonds. Remember, banks buy bonds. So when interest rates go up, like when you hear that the Feds are hiking by say 50 basis points, and you might be like, what the hell is a basis point? 50 basis points here is just a fancy way of saying 0.5%, so half of a percent. So when those rates go up, bond prices go down. And when interest rates go down, bond prices go up. Why does this happen, you might ask? Why do bonds have an inverse relationship with interest rates? Let us explain. The coupon rate of a bond is fixed when it is issued. Again, you might be like, what the hell is a coupon rate? Coupon rate here being the interest rate of a bond when the Feds increase rates as inflation goes rampant. Newly issued bonds have a higher coupon rate or higher interest rate than existing bonds, making the existing bonds less attractive for investors. To further elaborate on this, it is important to understand and consider the relationship between bond prices and their yield, which is the return an investor earns from holding a bond. When interest rates rise, newly issued bonds will have higher coupon rates, which means that they offer a higher yield to investors. As a result, the price of existing bonds with lower coupon or interest rates will fall as investors sell these bonds to buy the new bonds with higher yields. Similarly, when interest rates fall, newly issued bonds have a lower coupon or interest rate, which makes existing bonds with higher coupon rates or interest rates more valuable, and thus their prices will rise. So it's an inverse relationship. Hope you understand. Now, if we understand that banks invest in supposedly risk-off assets like bonds, and these bonds get less valuable as the Feds raise interest rates, it therefore means that your money which you left at the bank was invested in something by the banks, and now it is worth less. So banks are losing your money. In high inflation environments, your paychecks may not be able to keep up with your expenses because things are getting, more expensive. That's the meaning of inflation basically. I mean, even business owners will have to spend more as things are getting more expensive. You might have noticed this, by the way. What you used to buy for $5 2 years ago is no longer $5. So what's the only option here? To go to the bank and collect your money. So we see that the rate at which people would withdraw money from the bank in conditions like this would be higher in a higher inflation environment. So that 10% reserve that the banks are supposed to be holding from customer deposits may not suffice in times like these. Some banks may even result in selling those bonds that they bought at a loss to honor customer withdrawals, which will again only get some customers spooked. As a result, customers will know for a fact that the bank does not have their money. That's how we end up in a situation where people start running to the bank to get their money back. I mean, you do not want to be last if you know that the banks may not have enough money. This is called a run on the bank. And no, it is not metaphoric. People literally would run to the banks to take their money back. As this happens, the bank can no longer function as it needs your money to make its money. I mean, public trust is gone as well, and I don't think any of you would trust a bank that has gone through this before. The current banking crisis is not something that just popped out of the blue. It's something fundamentally wrong with the current financial system, as we have clearly seen. when banks start to fail, the Feds are cornered in a conundrum. It is either they pivot and stop raising interest rates and print money, which will save the banks but drive us into inflationary oblivion, or hike interest rates by a full percent, which will drastically decrease inflation but take the banks to the gallows and the entire financial system down with it. It is a no-win situation, as we have been seeing the repercussions of it leading banks to their unending fall, which is what I consider to be early symptoms of the greater plummet that is to come for the entire system. This is the reason why shifting to a system that is open source, not controlled by anyone, that does not reinvest your money, may be a better solution. A system that essentially makes you your own bank. A system like Bitcoin. Thanks so much for watching the video. I hope you did enjoy it. I hope you did learn something from it. If you have any questions, let me know in the comments. If you think I failed to mention anything, also let me know in the comment. I will like to hear your thoughts. You may use the links to our Discord and Telegram channels in the description, and I also have my referral links to exchanges I use in the description. Using them will go a long way to support the channel. Until the next video, people, stay safe.